Good morning, sir, class. This is Cadet Chauvin, and today I'll be explaining Chapter 7, Problem 3, and this is for bonus screencast. So the problem given to us is, it says Acme Company's financial statements included in the 2018 Form 10-K reports the following amounts in millions of dollars. Revenues for year end May 31, 2018 was $30,601. Net accounts receivable for May 31, 2018 was $3,358, and net accounts receivable for May 31, 2017 was $3,434. Some of the key terms to remember for these problems say it talks about revenue. So what is revenue? An inflow of assets resulting from the sale of goods and services is called revenue. It can be in cash or in accounts receivable, that is in credit form. The second term that we need to know for this problem is called accounts receivable. The balance of money due to a firm for goods or services delivered or used but not yet paid for by the customers. Accounts receivable are listed on the balance sheet as a current asset. Accounts receivable is any amount of money owed by customers for purchases made on credit. So when you are selling something to someone, and if you are not receiving the cash immediately or selling on credit, so that payment is due to you by the customer, and that's accounts receivable for you from that customer. Now, our first question was, compute Acme's accounts receivable turnover ratio for the year ended May 31, 2018, assuming that all sales are on credit. So since all sales are on credit, that means we did not receive any cash, so it's accounts receivable. So we need to calculate the accounts receivable turnover ratio. Now let's define what is accounts receivable turnover ratio. The ratio is used to measure how effective a company is at extending credits and collecting debts. That means how effective a company is performing in collecting its debts from its customers or to extending credits to its customers. So the formula for accounts receivable turnover ratio is revenues over average accounts receivable. So average account receivable is the receivable from this year and the last year. So for this example, it should be the year from 2018 and 2017. So our revenue given from the prompt was 30,601, and the two accounts receivable for 2018 and 2017 was 3,358 and 3,434. So the formula is revenue over average account receivable. That means our revenue is 30,601, and we should take the average accounts receivable. That means we should add the accounts receivable from 2017 and 2018 divided by 2. That gives us average accounts receivable for this question. So if we use this formula accordingly, and if we divide 30,601 with the average accounts receivable for the 2 years, we get 9.01. What this means is that for that specific time period of the financial statement for this company, it receives its account receivable 9.01 times for the whole accounting year. The second question we had was, what is the average collection period in days for an account receivable? So let us first know what is average collection period. It is the average number of days between the dates that credit sales were made and the dates that the money was received or collected from the customers. So the formula for this is number of days in period over turnover ratio. So for this specific problem, the number of days in the period was 1 whole year. That means 360 days. And the turnover we found out from last question was 9.01. So we divide 360 days by 9.01, and that gives us 40 days. That means to collect one account receivable, the company takes 40 days. The last question for this problem was, do you think the average collection period for sales to these customers is reasonable? What other information do you need to fully answer that question? If we look at our answer, it's 40 days, which seems pretty optimum, like 30 days, 40 days. But you can really say from 40 days that whether it is good or bad, or it seems reasonable or not, because this Acme company takes 40 days to collect its receivable, but the Acme company is also borrowing money for continuing its business from other firms. And if the accounts payable date for Acme company is 30 days to other companies, but it is receiving its accounts receivable from its customers on 40 days, that means it's not good. But again, if it is more than 40 days, say it's 50 days for Acme company to pay its debt to its other companies, but it's receiving its accounts receivable in 40 days, that means it's doing better. So just specific information on how many days it requires to collect accounts receivable is not a solid answer to find out whether this average collection period seems reasonable or not. Some other information that we need to determine the reasonableness of the turnover periods are industry comparables, historical performance of Acme, and Acme's credit terms. So I just described that Acme's credit terms. Historical performance of Acme is how Acme was doing over the last few years, and also industry comparables, which means that how Acme was doing compared to other companies. So based on all this information, we can then make a correct guess that whether the average collection period of 40 days of collecting accounts receivable seems reasonable or not. That was all for me. Hope these answers make sense to you. Thank you. Enjoy.